Nice to have you here, Jurrien, in this format too.
Yes,
this is
thank
great.
you.
Now, do you have any idea what time it is?
No.
You're a bit jet lagged, I imagine. First of all, congratulations on 30 years.
Thank you.
What's the highlight? What's one highlight of your 30 years?
Well, there's many, of course, but the one I always come back to is when I was interviewing in early 1995 for the most obscure job on the planet, which was a technical analyst in the fixed income division. So there's only so many things you can draw on a bond chart.
Yeah.
But I went to work in the chart room, and the only way to get to the chart room is through Ned Johnson. And so he was the final interview of whatever 12 interviews I had. And it was amazing. We didn't talk about the job, just about the markets. Typical Ned Johnson sitting in his office. And those early days, I was already a chartist, but I really got a crash course in how really to display, statistical information in charts, because I would spend hours with him every week just poring over charts. And I sort of, the culture through osmosis really blended into me, the Fidelity culture and the culture about displaying information. And so those were very formative years where, unbeknownst to Ned, he was my mentor.
Well, that's great. And it all worked out well. You're here 30 years later. It's wonderful. Now, you seem to have dusted yourself off well from the playa.
Yes.
You were at Burning Man for 2 weeks off the grid. And there was a lot of prep before that, and then you went. You are, for lack of a better word, intense when it comes to information for all of us. There's your posts on LinkedIn, there's your videos weekly, there's all sorts of, there's forums like this and so on, and you're traveling the world also speaking to investors, and then you disconnect for 2 weeks. What does that help you do when you come back?
It's great, but you secretly hope that not much happens.
Yeah.
And in 2025, that's anything but a given. But in the early years when I went, so I've been going since 2017, I was always desperate to kind of be in contact with what we call the default world, mostly because, my kids were at home. But now my kids come with me, so I just have to worry about a call from my parents who are 91 and almost 98. But of course, these days, everyone has a Starlink, so it's easier to stay connected. But I make a deliberate attempt to be disconnected from the markets. And so it's a nice way to have a full reset. Otherwise, it's only kind of a half-hearted reset. And so it helps, the whole Burning Man experience helps me get grounded, get rooted back into what life is really about, because we can get lost in the data and the numbers. And, Neil and Ramona talked about signal-to-noise ratios, and this is how I increase the signal-to-noise ratio.
So it's a refreshing change for you.
Yep.
And it may explain some of the more cosmic-looking charts that you come up with, but we can get into that later. You're a frequent guest on many different publications, different podcasts, and so on, as Patrick was talking about. But you're also on a podcast / YouTube channel called The Compound with Josh Brown and his crew. I've seen you on that in many forms. And then recently, Peter Lynch was on that. And I hope if you haven't seen that, you'll look it up. It's 55 minutes, and it's well worth it to be reminded of all that, really fired him up when he was running Magellan for all those years. It was great to see him. Is he someone, actually, did you inspire that in some way? Because you've been on that show, and then they had the whole forum with Peter.
Yeah, so I've been on that show. I go basically once a year, and I was supposed to be the duo with Peter.
Denise was on it as
yes,
well. Yeah.
But I was in Europe. I was in London, and I had to go to a wedding in Geneva, and then from there I went to Holland for my parents' 70th wedding anniversary.
You had to go, yes.
Not many people make 70. So we had 3 generations of Timmers there. So I could not be in Boston for that. But it's a great show, and I actually just did an hour-and-a-half podcast with Barry Riddles, who is the head of the company that Josh Brown works for. But so Peter and I go way back. He lives a few blocks from me. I once had to go. I went to Spain for the FIL Madrid office to do a roadshow, and there's a super fan there among the clients, and the guy from the Madrid office says, is there any way you can get Peter Lynch to sign One Up on Wall Street for this client? So I called him up. I went to his house. He signed the book. We had tea, and then I went to Spain. So, but it's funny because back in the 90s, when I was just a lowly technical analyst, I would always prep him for his media interviews. And so I remember, so if he went on Wall Street Week or what have you,
Louis Rukeyser.
Yeah, Louis Rukeyser. I would feed him just, there's a bear market every so many years. There's been 27 since this date and blah, blah, blah. And so then as he kind of got into retirement, he did those less and less, but he would still call me. And now, ironically, I'm kind of the one doing it. I don't have his mane of white hair, but so I always liken it to, when he was kind of at the end of his active days, that if you watch a football game, you have the announcer in the field, and then you've got the guy in the booth, feeding statistics. And so that was me and Peter.
What's something you learned from him?
Just the consistency. Yeah. And well, actually, he had a very clever way of doing interviews, and I'm not saying that like it was an evil thing that he was doing, but he had such a command of the data that if you're doing a 4-minute interview on TV and you are just bombarding people with relevant data, no one can come back to that. So it's very hard to challenge. Not that I don't like to get challenged, but having the command of the data, and I do this on Mondays, and I'm very fortunate that I work with all the folks that you hear about, Ford and Adam and DW, DT. They make me very smart, or smarter than I otherwise would be. And so there's always all this stuff hanging around in my brain that, you can wake me up at 3 a.m, put me on the air, and I can be there. And I learned that from Peter, to always have command of the data.
He discussed things that I hadn't even heard him speak about before, and then he got into those key points that are in One Up on Wall Street, and one of which was about how consumers will spend hours trying to save $50 on an airline ticket, but they'll drop $10,000 into the market when they hear a tip on a bus.
Yeah.
It seems like in the last 5 years, there's more and more lower income earners that have come into the market, and they're inexperienced at this. Does that concern you? Do you have charts on that? What are your thoughts on the volatility created by the newer investor, if you will?
I'm not too concerned about it. So during COVID, so we've always not worried, but we would worry that prior to COVID, that the young generation of investors, like people my kids' age, had kind of apathy towards the markets. They were just not interested. And of course, we all know with investing that it's all about the law of compounding. And the earlier you start, the better off you will end. And I've had this conversation with my daughter, who is a 29-year-old ICU nurse in New York. I'm like, put everything away that you can. And so the lack of that interest among the millennials or the Gen Z, whatever they're called these days, I think generally was a concern. And then during COVID, all of a sudden everyone was stuck at home, no sports games to play with, and we had the whole Robinhood meme stock thing. And while that was very speculative and it ended badly for many, if you're a young person, you don't really have a lot of money to spend on that. So I think in a way it was a good way for younger people just to get involved with the markets, and then hopefully they mature and they realize from trial and error that buying on a tip or a rumor is not a sustainable strategy. So I think there is a benefit to that, and there's always going to be speculation. And when the money is easy, like it was in 2021, there's going to be more of it, and the cycles come and go, and it's just part of the markets.
So you're not concerned with the support within the market from an investment standpoint these days?
No. I think the market is generally supported by solid fundamentals, even though the price for every dollar of earnings that investors have to pay is high. That is a hurdle for young investors, right? If you invest now at a 25 PE, that's a higher hurdle than if you start at a 10 PE. But generally, younger people are buying on a dollar cost averaging basis, so they're going to spread that out over time. So the fundamentals are okay, and the pond is much bigger now to fish from. And we've heard this all day about international markets finally being competitive. So it's a good thing.
You've studied bubbles all your career. A lot of people, anytime you put on the media, there's a lot of questions. Are we in a bubble? Is it this 99, 2000? A book just came out from someone who's probably interviewed you called 1929.
Yeah.
There's the fact that all that's happening, and I think of the chart room with the media sentiment piece, the fact that all that's happening, does that mean that we're fine?
I think, yes. So there's a bubble in bubble talk right now, but I'm seeing it. I'm actually at 2:00. I'm doing an interview with the Wall Street Journal. Last Friday, I think I did 4 different interviews, media interviews, and it's all about the stock. The bull market has turned 4 years old, right? So we just had the 3-year anniversary of the cyclical bull market, and everyone wants to know if there's a bubble. I did this roundtable event in Atlanta 2 nights ago, and it's all everyone talks about. And generally speaking, bubbles are not really bubbles until no one thinks of it anymore as a bubble. So what typically happens, and I have studied them all the way down, back to the tulip bubble and the South Sea bubble, when Isaac Newton, he said, "This is a bubble, I'm selling everything." And then at the end, he's like, he had the FOMO, and so he got back in and he rode it all the way down. That's how bubbles work. So probably people are seeing it, they're getting out. And then, 12 months from now, when the multiples are 50 instead of 25, that's not a prediction, but like if that were to happen, and they see their neighbor driving a new Mercedes, they're like, damn, and then they get in, and that's the top. So bubbles always run longer than people think. Certainly that was the case in the late 90s. I don't think this is a bubble yet. It's getting frothy. But if you think about the late 90s, and actually one of my favorite analogs these days is that 1990s analog where, in 1994, Alan Greenspan raised rates 300 basis points, created one of the worst bond bear markets in history at the time. The stock market stalled out. It kind of went nowhere for a year. And then he achieved the coveted soft landing. Markets ripped. He cut rates a couple of times. To me, that's a parallel to 2022, right? That was a bear market. It was a worse bear market than 94, but it was one of the worst bond bear markets. It was an equity bear market. It was entirely driven by rising rates. There was no recession, no earnings decline. And once that heavy hand or foot was lifted off the brake pedal, the market ripped, and then Powell cut rates a few times in 2024. And then back then, in 98, we had long-term capital, which was a systemic crisis, but not an economic one. Market fell 22%, came back very, very fast. Greenspan cut rates 3 times, even though the market was having a lot of momentum, making new highs. And that, of course, ended up being the internet bubble. And that was, 5-6 years after the internet boom started, right? That started really with Netscape going public in 96. You can argue the AI boom started with ChatGPT in 2022, so we're only 25. But the 98 parallel to 2025, the tariff tantrum, 21% decline, very quick recovery. Powell just eased, is likely going to ease several more times. So you can't, it's hard to not see the parallel there. And so, but I think right now, the Mag 7 is driving the train. It's almost entirely supported by earnings. If you go back since 2022, the Mag 7 is up 4x. Their earnings are up 3x. The rest is multiple expansion. But they're trading at a 35 PE, and they've got a lot of good things going for them. So I do think it's early, but that doesn't mean it won't happen.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
But you're also seeing breadth in the leadership now, aren't you? In one of your recent pieces, you talked about how these start very narrow, and now there's quite a bit of breadth in leadership in the market?
So in many ways, this bull market, which is now 3 years old, has been kind of the reverse of the typical bull market, right? So a typical bull market starts at the depths of a recession. The Fed is cutting rates, earnings are falling. The market goes from getting, I think DT mentioned this, it went from getting more bad to less bad. I forget who it was who said that. And that is the early cycle phase of a bull market. And usually the cats and dogs of the market, the small cap stocks trading at $8 a share or what have you, those come back the biggest because they fell the most. They were the most cyclical, had the weakest balance sheet. So those come roaring back. So the market starts very broad. And then as you get closer to the end, 3-4 years later, market's very narrow. It's only the blue chip quality stocks hanging in there. This one started the opposite way. It started with the Mag 7, and I'm not saying it's ending with the Mag 7, but it's still the Mag 7 on a relative basis, but in an absolute basis, about 2/3 of stocks in the S&P are above their 200-day moving average, which shows decent breadth. But the big growers are so far ahead of the rest of the market that they just can't keep up. It's one thing if you're behind a couple hundred basis points and then you've got wind in your sail and you catch up. But when you're behind 1,000 or more basis points, it's hard to do.
Questions just come in. What's your favorite technical indicator?
Ooh. I would say that breadth is something that I look for. So percentage of stocks above their 20-day, 50-day, 200-day. It allows you to see oversold moments in the market. So we just had the sell-off a couple of days ago, and the percentage of stocks above their 50-day went down to 38, which is, it's not really that oversold, but it was also a one-day thing, and it recovered quickly. But at major oversold extremes, those numbers will go to 0 or 2% or something in the single digits. And you look at new highs versus new lows. I remember during COVID, March 23rd, 2020, the new highs to new lows ratio or the spread went to a level that outside of the Great Depression was only seen maybe like 3 or 4 times. And those are times when you can come with real conviction and say, look, maybe it's like the 1930s, but if it's not, you're not going to get a better opportunity than this to buy low. And that's one of the things I try to do, with our audiences on Mondays, and also my colleagues over in Boston and in Toronto and elsewhere, is to try to give empirically based technical advice on markets pricing and structure, so that there is a sense of confidence when decisions are made, because again, the signal to noise ratio these days is pretty low.
Let's talk about the team. You are part of the Global Asset Allocation Group. Not everybody knows that. They would think that you're part of QRI or something more cosmic. How do you work with the GAA team on a daily basis?
They are wonderful, extremely smart people, but the best part I find, and that's true for Fidelity at large, is that there's a great amount of humility, which is so important. I learned that from Ned. We'll see Will later. He's like the most humble person I've met, but yet he's brilliant, runs 300 billion. To me, that is a real sign of talent and just character. And so, I sit with Ford and Adam and David and people from SAI and other areas, and it's just they make me smart. They may not have the answers, but they ask questions that may be like, okay. So they're like, they know I publish every Sunday, and it's like, Jurrien, have you looked at this? Can you do this? And then sometimes some of my best ideas come out of that. But so I started in the chart room, and in 2005 I was plucked out of the chart room and put in asset allocation. Of course, I ran the Global Strategies Fund for 7 years. It did okay, but it was at a time of the financial crisis, and it was just hard to get traction. And we are in a scale business, so we all decided that I'm better off representing the company, on the air and on Zoom or before Zoom at that time. But so it's a great group of people, and it's just I'm blessed to work with very smart, objective, humble people.
Excellent. You've put together a deck of, I don't know, 40 or 50 slides for this season, and we're not going to go through them in the interest of time, but I'm sure you have a few that we could call up that you'd like to run the audience through.
Yeah. Okay, so yes. So these are animal spirits, if you will. So this is the Goldman Sachs Non-Profitable Tech Index. And you can see on the left there, that was the 2021 sort of Fed-induced asset bubble. Again, when money is easy and rates are low or too low, speculation inevitably happens, right? And every bubble, and that was sort of a mini bubble, but every bubble that bursts ultimately comes down to too much leverage on illiquid assets with a duration mismatch of where you borrow and where that cost of capital goes. And so that was 2021, and then those stocks fell 70%, laid dormant for several years, and are waking up. And you asked about an AI bubble, and that is sort of my exhibit A of saying, okay, are we about to enter silly season on speculation?
And so that says no.
It says it's starting.
Okay. Next slide.
Okay, so fiscal dominance, one of my favorite topics, and David Wolf talked about this earlier. So I think, we're obviously in a highly politicized environment, politicized Fed. We all know about politics in Washington. You all have been in the crosshairs of that, of course, unfortunately. But I think the Trump administration is making a deliberate attempt to grow out of the debt. And it's hard to argue with that because there's too much debt all over the world, Canada, UK, Europe, China, Japan. And in many cases, the growth rate in the economy, the speed limit, if you will, is very low because of aging demographics. And so you end up with this debt burden where your debt to GDP is 100+%, and you're just borrowing to kind of stay afloat. And earlier in the year, the topic, of course, politically was, well, we're going to cut all the waste. They sent Elon Musk to Washington. He was going to cut $2 trillion. He got maybe a tenth of that.
Yeah.
And he found out the hard way that nothing stops this train. There's not enough discretionary spending to cut. It's all entitlements and defense and debt service. And so if you can't cut your way out, and obviously you're not going to default your way out, then the only options are to grow or to devalue your way out, either through currency or through negative real rates or both. And so right now, the gamble is, and it's a high-stakes gamble, is they're going to try to grow their way out. That's what the One Big Beautiful Bill was about. But it creates a risk, of course, and that is that the bond market doesn't like it. The bond vigilantes start selling, and you heard this morning that they don't own any treasuries, and so that could be par for the course. And then rates will rise, and if you have a politicized Fed, where the Fed cuts rates lower than what is economically justified, then inflation will pick up, and the yield curve will, what we call, bear steepen. And then the Fed would have to come back in and do yield curve control like the Bank of Japan did and what the Fed did back in the 1940s. And so the easy way to kind of track that is in this chart. You see the blue line is the 5-year rate of change in nominal GDP. The green line is my estimate of where the 10-year yield should be and is going. And if the blue line is above the green line, your debt is sustainable, so you're growing faster than your cost of funding. And if that were to change, then you either need to increase your growth or you need to repress the cost of funding. And so maybe the AI boom bails us all out. Maybe the One Big Beautiful Bill creates that entrepreneurial spirit that boosts growth. But if that is not happening, and you're not importing people through immigration, then that speed limit is going to stay low. And then you need to lower rates. And that gets you into the Fed and its independence. And that's a whole other, can of worms, of course.
Indeed. Could I tangent off of that government debt slide to consumer debt? I'm curious if you're concerned about where consumers sit today, in particular in the United States. And I ask that because I was reading recently about the buy now, pay later programs that people get into. There's a slogan, it's like eating a jug of ice cream today and then dividing the calories over six or so weeks. There are people leasing lifestyles today. They're just trying to go beyond where they should, and they're defaulting. Is that something that you see ramping up?
Yeah, I've never thought of amortizing calories. That's an interesting concept.
Not my words.
So the good news is that household debt to GDP peaked in 2008 at 100% of GDP. Today, it's about 70%. So this was, of course, financial crisis, the housing crisis in the U.S. Everyone overextended on rising home values. They not only had a mortgage, but they took out lines of credit. In some cases, used that equity to buy other homes. We had the no-doc mortgages. That whole sort of that whole bubble-like situation in mortgage underwriting. But that has greatly improved because back then the government essentially took over the debt. Right? I mean, not literally, but government debt started going up. So there was like a transfer, if you will, of the debt burden from the private sector to the public. That hasn't really changed. So household debt to GDP is 70%. Generally speaking, I think the consumer is not overextended, like they're employed, wages are somewhat keeping up with inflation, home values are fairly high, so people have equity in their homes, the underwriting standards are not too loose. There's always going to be people that overextend themselves, and obviously with the wealth inequality that we have, it's a risk because the lower, let's say half or even more than half, are living paycheck to paycheck. And of course with COVID, we had that kind of revenge spending, revenge travel. People got stimulus checks. And so that's obviously going to end badly for some. But the underpinnings of the labor market, even though not many companies are hiring, they're also not firing. So at least you have a low starting point of debt to GDP, and you have essentially a fully employed population. So I'm not overly concerned, but there's always going to be those excesses.
Thank you. Next slide.
All right, secular bull market. Many technicians disagree with me as to the start of this one, but in my view, the current secular regime started in 2009, and this one compares the current one in the gray line to the one from 1982 to 2000, the one from 1949 to 1968, and the short but sweet one from 1921 to 1929. And what I find amazing, actually, is how similar the trend lines are for all of them. And so, but the question is, we're now year 4 in a cyclical bull market. We have the AI sentiment really, running the show here, and we're in what I would think is sort of the 8th inning of a secular bull market. And it makes me wonder if we're going to end up, with a whimper like we did in the late 60s, or with a bang like we did in the late 90s. And there are interesting cases for each. Ramon was talking about glamour. The 68 peak was the glamour stock peak, right? It was companies, any company with the word tronics in it went to a 50 multiple. And then we had a recession in 1970. The retail trading public sort of disappeared, and the market was in the hands of institutions. They only wanted to buy the blue chips. Those were the Nifty 50. So that was the first era of the Nifty 50. Of course, the late 90s was the second era. The top 50 companies of the S&P from 98 to 2000, the PE went from 20 to 40, while the rest of the market went from 20 to 20. So that was like a bubble in big growth companies. And so we're seeing, obviously, elements of that. And so I wonder, what is going to be the end game, with the caveat that it's a sample size of 3, and so this one could go for 25 years. Like who knows? But again, I look at the historical context and try to make sense of it, knowing that history doesn't repeat, but it sure does rhyme, and this one is rhyming with the 90s.
And is there a fourth chart? There is. Fourth and fifth.
So lots of discussion today about international stocks. I'm very excited about this. I've had many conversations over the years with my colleagues in global asset allocation about diversifying from U.S. stocks to international because the valuations were so attractive, are still so attractive. At the peak of the U.S. relative to international boom just earlier this year, the U.S. was trading at a 65% premium to non-U.S. stocks. That's now down to about 45%. But what's exciting to me is that when you look fundamentally at valuation, you look at a discounted cash flow model, you look at earnings growth, you look at the growth in what we call the payout, so dividends and buybacks. That's the share of earnings that get returned to shareholders. And you look at the payout ratio, the percentage of payout to earnings. And what we're seeing now for the first time in a long time is that the U.S. fundamentals are great. The payout ratio is 75%. You can see the orange line is earnings, the gray line is the payout. They're both growing very nicely. But you look at the IFA, which is non-U.S. developed stocks, they have now the same payout ratio, although 2/3 of the payout is dividends and 1/3 is buybacks, as opposed to the opposite in the U.S. But the payout is actually growing faster than in the U.S. And that seems like hard to believe because the U.S. is all growthy and has all this dynamism, which Europe and Japan don't. But as I think Patrice was saying earlier, they're unlocking shareholder value. They're much better, more savvy at unlocking shareholder value. So European banks, which were trading at half times book, are now buying back shares to unlock that value. So even though the top line growth is not as compelling, the payout, the share of those earnings returned to shareholders, is now really competitive. So now you have global equities, especially developed, in my view. EM stocks tend to not buy back shares. They tend to be dilutive. But developed stocks are competitive in their fundamentals, but they're trading at a 16 multiple relative to a 25 multiple. And I think that's a great thing because we obviously have concentration risk in the US market. 7 stocks are 36% of the index, and there is alpha to be had now internationally. So to me, a barbell of cap-heavy S&P and non-US stocks is something that is now available that wasn't available even a year ago. So it's a bigger pond to fish from, which of course is good for everyone.
Let's transition to a question that's just come in about capitalization. Is there more strength in small and micro caps now?
So there is a lot of strength in small caps. So if you look at the Russell 2000, it's really caught up. But why is it caught up? It's because of the non-profitable stocks. That was the first chart that I showed. And so I think it's a hard game. So if you're relatively benchmarked, which of course we all are at Fidelity, how do you mitigate the concentration risk? Do you sell the Mag 7 and go micro or small cap? Maybe, but that's a very binary thing, right? Because if you miss out on the Mag 7, you're missing out. So I think my approach is to paint with a broader brush and go international, because you're going to get a lot of the same attributes of this small value type of style box, but you're doing it in a different market where you don't have to make the binary choice, and you can expose yourself to currency. And again, the weaker dollar outlook from the panel earlier is one that I agree with. So it gives you a little bit more, I think, room to express views.
We just have a few minutes left. I've got to ask you about Bitcoin. Has there been a disconnection in the last little while with the NASDAQ in particular?
So my analogy for gold and Bitcoin is, gold is boring, it's store of value. Well, it's not boring lately. And Bitcoin is like Dr. Jekyll and Mr. Hyde. Like it can act like gold one day and act like the NASDAQ on steroids the next day. Yeah. So if you invite gold to the party, they're going to have one glass of wine and leave at 9. And with Bitcoin, it's like you just don't know what's going to happen, right? So, but I view gold and Bitcoin as different players on the same team, and they take turns. Ironically, gold and Bitcoin have a negative correlation to each other, which is something I never would have guessed. So obviously, gold is running right now. It's in part the fiscal dominance theme that the two Davids talked about. In part, it's geopolitics about China exerting its dominance while also hedging its risks against what it probably would call the weaponization of dollar reserves. And so there's a secular and there's two secular themes going on that are kind of independent from each other. And, Bitcoin gets plagued by too much leverage or a flash crash, which is what it just had. But I think they're both players on the team. And for me, the ratio is 4-to-1. That's not investment advice, but 4 gold, 1 Bitcoin. They equalize the volatility, or that equalizes the volatility. So to me, if you want a store of value, hard money bucket in a portfolio, that's kind of the bucket for me.
I've got 5 questions about you. 4 or 5.
Oh, no.
Favorite podcast?
I have to say Compound and Friends. They really do a great job. And not the one that I'm on, but just in general.
Where would you want to live for a year?
Santa Barbara.
Santa Barbara. And the last movie watched?
One Battle After Another, the new Paul Thomas Anderson movie.
Best ice cream?
Vanilla topped with Fruity Pebbles. It's got to have Fruity Pebbles.
Fruity Pebbles. That stuff will kill you. Quiet environment for doing your work or a bit of noise?
Every Sunday when I write, I put my father's 50-year-old vinyl records of Bach on, and that is how I work.
Excellent. You are someone who continuously educates us. We appreciate that. We didn't cover a lot of areas today, but you can see Jurrien every week and read his stuff. Follow him on LinkedIn. Thank you very much for joining us today.
Thank you.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.